as long as there was a longer time horizon in terms of your investment period, there really shouldn't be any issues. There's dips and peaks to the market, but ultimately, if you have a longer term view and a sound capital structure, you should be able to weather the storm.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Christian Gore is the founder and managing partner of G1 Capital Partners, a private capital firm specializing in multifamily and industrial real estate investments. Christian, welcome to the show.
Appreciate it, Sam. Thanks for having me.
Absolutely. The pleasure is mine. Christian, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start, where are you now, and how did you get there?
Sure thing. So I started as a young little kid coming up in West Texas. Ultimately worked my way through the system. Got involved with significant real estate guy by the name of Andrew Farkas. Was kind of my first gig in New York. Really kind of drinking from a fire hose in that environment for about 4 years post GFC, which was quite interesting, and ultimately worked through a handful of buy side and sell side shops, over the years, and founded G1 Capital Partners in 2018, and we've been operating since then.
What do you guys do at G1 Capital Partners? I know you said there in your intro, you guys are into multifamily and I believe it was industrial, but give me kind of the breakdown of what you guys have done over the last 5 years and where you're going.
Sure thing. So I would say primarily spend our time in the multifamily and industrial space. That being said, we are agnostic to product types. So for example, we've got a hotel deal in front of us right now. So really just looking for the right opportunities in the right markets, and less so focused on product. Historically speaking, I will say 90% of what we've done is in industrial and multifamily. We do have some retail holdings as well, and currently don't have any hospitality, but we'll likely have hospitality by Q1 of next year. So we kind of have the whole spectrum of the 4 major food groups, or at least we screen it, but ultimately spend most of our time in multifamily.
Got it. Okay. That's really an interesting thing. How do you effectively grow or manage your team and your investor base when kind of bringing a new asset class into the mix?
Sure thing. I would say first and foremost, we're extremely technology focused. So that takes a lot of pressure and, quite honestly, what I would call biases away. So it not only helps our processes, but it also helps our team internally kind of select the investments and really get behind them. But ultimately, I mean, it's math. We're integrating a lot of data that effectively is taking in AI and machine learning, and we think that's a little edge that we have there. But at the end of the day, it's math. In this business, it's relationship driven, and really just utilizing what we have as a team. The team is probably the biggest component, I think, in our business success. I'm an ex college athlete, and I look at it no differently in kind of our industry as it is in sports. I really do think the best team ultimately wins and gets the best opportunities across the finish line.
Yeah, undoubtedly. When you say team, and especially as it pertains to, let's use hospitality as an example, are you guys scaling internally? Are you scaling with external partners in hospitality? How do you engage a new asset class and maybe without having to go through the attendant learning curve that taking on a new asset class generally requires?
Sure. That's a great question. So historically we've have about $2 billion in experience in the hospitality space. That was primarily post GFC, but our kind of thought process and business model internally is right now we're a team of 5. Over the next year or two, we'll probably get up to a team of maybe 10, 15 max. And the way we're able to scale that is one, like I mentioned, through technology, but two, leveraging our partners. So we don't manage any of the assets, boots on the ground. We bring in an operator, in this case for a hotel. It's a very niche product type. So we work with the top 3 large hotel operators, and kind of leverage their expertise in that space. So it's not to say it's the Marriotts of the world. It's the operators or the property management team on site that's kind of below that umbrella. If that makes sense.
It does. It does. Okay. No, that's great. I love that. And I don't want to stay here, I guess, too long, but I am curious. I mean, you guys are making hospitality one of the potential things that you guys are getting into either end of this year or first of next year. Why now? I guess we'll start there, and then I have some follow-on question to that. Why hospitality? Why now?
Sure. So I wouldn't market too much in the hospitality space. Kind of the 3 buckets we're playing in right now is multi-industrial, and then what I would call special situations. And in this case, this hotel opportunity that we have in front of us is a special situation, has a great story behind it. It's a post-COVID REIT effectively blow up. So very low basis, needs a lot of TLC, a lot of CapEx, really a lot of work put into it, but we like the story behind it, and it's extremely core asset right in our backyard. So headquartered in Dallas, it sits a rock's throw away from our office. So we know the asset very well.
Got it. Okay, that makes sense. So you guys aren't necessarily out saying, "All right, we're gonna put a full-fledged team together to go out and acquire hospitality in mass." It is, hey, here's a great opportunity right in front of us. So why don't we see if we can make this work?
Exactly. And then we obviously allocate the right investor profile for that kind of product, if that makes sense.
It does. And that's an interesting thing to be able to go, okay, let's take advantage of this situation without necessarily wanting to develop all of the resources to go out and go long in that space. Is that a fair kind of a analysis of what it is that you guys are dealing with right there?
100%. Yeah. I mean, we're not going to be growing a massive hospitality platform anytime soon. It's more so, hey, we know this deal really well. We can put all the pieces together. We have the right, partners on the equity side to execute. And ultimately, our whole team is really just a bunch of deal junkies. So it's really fun to put, hotels, there's a lot more moving pieces. So it's a lot of fun to work on.
I bet it is. Yeah. And I'm with you on the opportunity side, where it's like, okay, there's a great opportunity. How do we say no? I mean, those are hard to pass up when they're right there in front of you. And especially if you don't have to build all of the necessary parts that go into, taking that one particular niche business to scale. It's like, okay, we're going to buy this and you can plug an operator in, and it's not the end of the world for us to acquire that. So, okay.
Exactly.
I won't beat you to death on the hospitality industry then, but you did mention something. You said you have the equity behind you to take down that deal, but let's talk a little bit more about capital markets as a whole. How has that affected what you guys are doing? How has that affected what you guys are doing in multifamily, in industrial? Maybe you can compare the two, give us some insight, what you see there, and how you guys are navigating 2023.
Sure. So I will say it's been 2023 has been tough. I mean, the fastest Fed rate hikes we've ever seen in terms of speed. So it's really a shock to the entire system, right? So we've been, working to try and get stuff done, have not been successful this year, just mainly due to rates moving that quickly and continuing to move. That being said, we do see a bright spot starting in 2024. There's obviously, going to be a lot of pain. That being said, we're very focused on scaling the multi side of the business, and to put more strategically the affordable multi side of the business. So we're all in on that. That's our scaled growth product for the next 2 years. Industrial still is not pricing to where we think it makes a lot of sense. And candidly, from a lending perspective, which is quite honestly the biggest challenge in today's environment, the beauty about multifamily is, the fact that we have two large government agencies that are, still lending on that product. And that's, what I think has been fruitful for the multifamily space compared to, all the other four major food groups. That being said, nothing's easy in this environment. So
No, there's no giveaways. What about distress? Let's talk distress there in multifamily. I hear a lot of people, even shops that I'm a little surprised at that previously weren't in multifamily now going, hey, we're getting into multifamily because we feel like there is either currently pain that we can take advantage of, and or they see a coming theoretical wave of multifamily opportunities. Talk to me about that. What's your view?
yeah, that's the $1 million question, right? You've got folks raising distress funds. It's tough to say. We're tracking it as well as we can and other folks can. I think there will be some opportunities probably in Q3 of next year, but what we're seeing live in the market right now is a lot of pref equity flooding the space and plugging a lot of gaps. And we don't currently and have not put out any pref equity in the space, primarily due to where valuations were going in. We still didn't really feel comfortable, plugging a lot of the gaps at that basis. But I think there will be some pain. We're seeing some. We're working on some. But I don't think it's going to be as bad as everyone thinks. If you look back, to 08 and the GFC, like I mentioned, we did my first gig was working for some Lehman guys post GFC, and we did a lot of workouts. We did about 6.5 billion. And I'll be honest with you, I think I'd have to look back at the deal sheet, but maybe 1 or 2% of all of those deals that went bad were multifamily, and the rest were other product types. So I think there's definitely pain, but there's a ton of liquidity still out there ready to take over. So in a long-winded way of, I don't think it's going to be as bad as everyone thinks.
I don't think it'll be as bad, or at least I hope, it won't be as bad. Primarily, one, because I'm not a buyer of multifamily personally. So it doesn't, on that front, it doesn't affect me one way or another, although I'm an investor. I'm not a personal buyer presently of multifamily. Also because I don't want to see a lot of our friends in the industry go through that hard times. But regardless of what I want or prefer, it still happens. Let's talk about pref equity a little bit. I mean, that can fill the gap for a while, but then what happens when that, and maybe you can give our listeners that might not understand what pref equity is, what it is, and then my follow on. So first question is, what is pref equity? Can you define that for us? And then secondly, what happens when that pref equity runs out? Are they just, kicking the can down the road?
Yeah, I mean, so the short answer is, definition, I would say it's called pref equity, but kind of operates more like a debt product. So, you have your common equity, and then ultimately your pref equity, which is coming in behind it that has preference over the common equity. And so ultimately, once, let's say, cash flow gets low, groups are plugging in pref equity and to your point, kick the can down the way. Ultimately it's going to be the performance of the asset on whether or not that pref equity stays in place. So there are instances, for example, that we're aware of, that groups have plugged pref equity, and at this point in time, their pref equity is already completely wiped out. So ultimately, it's come down to the senior lender or the original, originator of the initial loan on the asset level. So it's challenging out there. It's very deal by deal. It's market by market. It's very, very specific. It's interesting time.
It really is. I mean, because I think about some deals I'm aware of that are doing terribly, and then I know about some other deals that I'm personally invested in that are, I mean, just killing it. I mean, there's like,
Yeah.
you wouldn't even know that there's any stress in the market. We're still above pro forma across the board. They're 99% occupied. It's like, I mean,
Life is good.
life is great. Like, how is this possible? I don't know, but it really is. It's on, I think, like you said, on a deal by deal basis. Are there any types, or should I say classes of multifamily that you're saying, hey, this is where we're going to see the most distress, in your opinion?
Yeah, I would say, generally your older, 60s, 70s, even 80s vintage product, where at the kind of the peak of the market, folks were getting very aggressive on pricing, very aggressive on leverage, and ultimately, solving for, not so ideal capital structures. And those are the folks that I think will have the most pain. But for the most part, as long as there was a longer time horizon in terms of your investment period, there really shouldn't be any issues. There's dips and, peaks to the market, but ultimately, if you have a longer term view and a sound capital structure, you should be able to weather the storm, which, I think everyone's saying survive till 25, which it seems to be the timeline here.
Seems to be, and I think, except for some people, unfortunately, it's probably wishful thinking, is that things will, turn around and get better for them by 2025. But again, getting there is step one, and two, having a meaningful business when you get there is step two. So we'll just see how that shakes out. I don't want to be all doom and gloom here on the show today. You guys have been net sellers for what, the past 12, 18 months or so?
We have, yeah, we've been net sellers. We had some assets trickle into 22 that got a little challenging to execute, but definitely net sellers.
That's awesome. I mean, that seems like you timed things fairly well. And then we talked about this a little bit off show. So you guys have been net sellers. You said this in the beginning that you really haven't found much here in 2023 that's made a lot of sense to buy. We see a lot of shops that are in asset management mode. You guys are obviously in buy mode. I guess talk to me a little bit about that. Like, how do you ride out the storm? How do you remain patient? What are some things you guys are implementing in your core disciplines that are kind of keeping you true to what you're trying to do?
No, that's a great question. I mean, I would say we're just trying to keep a pulse on the market. It seems to be moving on a weekly basis. But internally and kind of in-house, our view is that, capital will start coming back to the market next year. And we are pretty bullish that rates are going to drop pretty significantly post-election of next year. So from a timeline perspective, that's kind of how we're thinking about it internally. But to say that it's still very difficult to be patient, right? When you're, looking to buy and so on and so forth. And quite frankly, the model we run is what I'd call kind of a separate account model. So we go to equity partners, on any given deal that we think, fits the equity check and fits the profile, the market, so on and so forth. And ultimately they're really calling the shots. We invest alongside them in, as a GP, obviously, but ultimately they're writing the large LP check here. So and they're pretty much on the sidelines in this environment right now. The big kind of feedback that we get from most of our equity groups that we're talking to, on a daily basis, is negative leverage. And so, what does that mean? That, it means, hey, in the multifamily space, we can get debt at 6.5, so at minimum, you should be buying a 6.5 cap unless there's, a true path to some sort of 6.5. So that's kind of how we're looking at the world. And the capital markets just hasn't really adjusted to that yet. And we think Q1 of next year, it will probably get to where it needs to be.
Yeah, I'll be honest. I hear the term negative leverage, and I kind of get scared.
Cringe.
It's like, wait, this doesn't make any sense. At least, obviously, like you said, unless there's a clear path where it's like, oh, hey, this is under market. There's an easy value add. There is all these, earmarks of just something that the present owner.
It is not all doom and gloom, Sam. We have 3 or 4 deals under contract right now, so there are opportunities. I want to throw that out there. It just, instead of looking at 20 and finding a couple, it's like looking at 200 and finding a couple.
Right. No, undoubtedly, it is certainly not all doom and gloom, and I don't want to portray that here, but it is something where I think it's just interesting to watch what everybody's doing, and I think it kind of sounds like what you guys have been doing this year, watching the market, watching other sponsors, watching how deals are trading and going, does this fit what we want to do? Does it make sense now, or should we wait? What's the right move? And I think that's okay, especially if you're not sellers. I mean, that's one of those things where it's like, if you have assets to sell and you sold them at the right time, you know what, it sounds like you're doing the right thing and kind of protecting your downside along the way. So this is great. I've really enjoyed, Christian, having you on the show today. Certainly have learned a lot from you. I mean, you give us insight on the capital markets, on, what it's like to get into special situations in the hospitality space when those cross your desk, kind of what your thoughts are on industrial, and then how you guys are taking advantage of multifamily, and then what your just thoughts on the general market at large are. So certainly appreciate your time here today. It was great having you on. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Yeah, I would say feel free to reach out. We've got LinkedIn, we've got our website. I believe you have all the info on us, Sam. But we're a small team. We're active, so we can typically get back to you pretty quickly.
That is fantastic. And if our listeners do want to find your website that aren't necessarily watching the show or get into the show notes, what is that website where they should go find you?
Sure. It is g1capitalpartners.com. And I believe our Instagram handle is G1_capital, and our LinkedIn should be G1 Capital.
G1capitalpartners.com. We'll make sure we put that there in the show notes. And Christian, again, thank you again for your time. I appreciate it.
Fantastic. Thank you, Sam.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much, and hope to catch you on the next episode.